Bismillahirrahmanirrahim. Assalamu alaikum. Good evening, everybody. This is our last session in marathon series, and we covered almost all important standard. And today is the last session. And in this session, we shall be covering International Accounting Standard 12, income taxes. This is a complex standard, no doubt. This is a complex standard. Normally, it is also difficult in implementing on practical scenarios. And so I will try to explain underlying concept as easy and clearly as possible. And if one works through the illustrations and the examples which I have included in this session, so hopefully he will be able to revise and refresh this concept very clearly and will be able to apply this concept on different practical situations. So I have designed this session without technical jargons. I have avoided to maximum extent the technical jargons because this is a very simple concept. Though I mentioned this is difficult, but if we just ignore that fear which is in our mind related to this concept and listen to me carefully and raise relevant question and ask for relevant explanations. So I'm very confident that by the end of this session, you will feel that this is not that much difficult. So we shall be, in fact, discussing the concept. Okay, let's start with, and there are a few basic examples as well. Okay, we are going to discuss, in fact, income tax. Okay. Income tax. Tax on your income. See, in broad category, these are of three types, like current tax. What is this current tax? In fact, very simple. When you multiply taxable profit with the prevailing tax rate, so this will give you the current tax. So before we move further, please tell me if you people can hear me very clearly. So comment in your comment box so that
the person is saying yes, Ijaz now, yes, thanks, Maria Surreal, yes. No slides for today.
No, there are slides. But I included answer to a number of questions within the slide, small, short questions. So had those been provided earlier, you would have seen those answers. So that's why by the time we finish this session, you will be receiving the slides. There are slides, but the important thing is try to appreciate this deferred tax concept with me. Of course, slides will be there. So we'll be using a slide. Okay, this is the current tax. This means you people are hearing me. Current tax. What is current tax? Simply taxable profit into the tax rate. What is taxable profit? Taxable profit, we know. Profit as per the tax law or as per the taxation principles. What they do, you will be adjusting your accounting profits with the income and expenses, which are allowable or which are not allowable, or which are allowable in a different way, like some expenses are allowed on a cash basis. Similarly, some income are allowed on a cash basis, and like this. So, and depreciation rates are different. Like for accountant, depreciation is calculated based on the IFRS, whereas the depreciation rates given by required by the law could be different. So that's why the tax person may be reversing your accounting depreciation and then deducting the depreciation in accordance with the tax law. So after making all those adjustments as per the tax law, you reach to the taxable profit. I mean, all these adjustments are made in the accounting profit. I mean, you take the accounting profit and when you make adjustment for various items, plus, minus, so this gives you the taxable profit. And these adjustments are purely based on the tax law. In fact, taxable profit, we know that, is the profit as per the tax person. This one. Okay. As per the tax person. So this is the current tax. And if it is payable, so we will mention current tax payable. Then the concept is income tax expense. See, expense. Current tax is based, as we can see that, on tax law. As per tax law, what is the amount which should be paid? But expense is, of course, will include the current tax. This will include the current tax. But this will include or exclude other items as well. Sometimes what happened, from tax people point of view, your profit, your taxable profit is a lower figure. Whereas from accounting point of view, your profit figure is a higher figure. So this means your current tax will be a lower figure when you calculate it using the by applying the tax rate on the taxable profit. That will become a lower figure. But when you apply the same tax rate on the accounting figure, so your income tax is higher than the current tax. So why it is that we know that this is because of difference between the accounting principle and the tax principle. So what you do, you normally recognize it as a deferred tax. Mean you will have to pay it sometime into the future, or you will be getting benefit for that payment. If you have paid more under current tax, then you calculate it as an income tax expense. Of course, deferred tax concept. Deferred, as its name suggests, you will be settling it sometime in the future. So current mean now, and or within a period of 12 months, and deferred mean, of course, more than 12 months. So what we will be discussing the basic concept of the deferred taxation. Basic concept of the deferred taxation, with the help of example, how it created, and then we link it with the underlying concept of tax base. First, we shall discuss with the help of two examples what is deferred tax, how it affects our income statement, how it affects our statement of financial position, and how can we calculate deferred tax from statement of financial position, and what is the methodology for the calculation of the same from the income statement, and then the underlying concept of tax base will be discussed at length. Then we will take up special cases like leases, like share-based payments, like compound financial instruments, and thereafter business combinations. How this concept affect business combination. If I could convey you the concept of tax base, or if I am able to make you comfortable so far as the tax base, concept of tax base is concerned, so I feel that we have done with this session, because this is the core concept. Like, if you are able to calculate tax base, this means you have done with the significant part of the overall concept, which is given in International Accounting Standard 12. Okay, let's come to the slide. Okay, example 1. Example 1 is, see, very simple example. Assume we have a fixed asset costing 75,000, and accounting depreciation rate is 20% using straight line method, and residual value is nil, and assume accounting profit before tax is 80,000 per annum. And capital allowances or tax depreciation are assumed as 50% in year 1, 25% in year 2, and then again 25% in year 3 respectively. But this asset has got 4 years life, 4 years or 5 years, and from tax point of view, there will be no depreciation in year 4 and 5. Tax rate is 30%. So this is the small example in front of us. Okay, let's see how it affects our tax position. See, from accounting point of view, first year, we assume that 80,000 is the accounting profit before tax. Then taxation based on accounting profit, and that is 30% of 80,000 will become 24,000. So from accounting point of view, profit after tax is 56,000. This is accounting point of view. Okay. Likewise in year 2, year 3, year 4, year 5, and total is like 280,000 profit after tax. 80,000 was assumed. As we saw in our last slide, 80,000 was assumed accounting profit before tax. Then we applied tax rate of 30% on this 80,000 to in order to calculate 24,000, and then 50,000 is the difference between these two figures. And here is the total of the 5 years. Like 400,000 is the profit, and total taxation is 120,000. We are interested in this 120,000 figure. Okay. Now, from tax point of view, in year 1, that for tax purpose, you will be adding back the accounting depreciation into the, because here we are going to calculate taxable profit. The tax person or the taxman will calculate taxable profit from your accounting profit. Here we are assuming that there are no other differences except this depreciation. From accounting point of view, depreciation is 15,000, whereas from like tax point of view, the depreciation is 37,500, which is 50% in the first year. As we saw in our basic information related to example number 1, that tax depreciation is 37,500. So this will become the taxable profit. So then the tax person will multiply this taxable profit with the tax rate of 30% in order to calculate the tax amount. and thereafter we can calculate profit after tax 40,250. Likewise, in year 2, the same way tax person or the tax inspector will reverse the accounting depreciation and reduce the profit by the tax depreciation, which can be named as capital allowance, and this will give him taxable profit. Again, he will apply 30% on this profit in order to calculate profit after tax. Likewise, in third year, here you can see that again the same figures, because in third year we know that 25% was the rate as per the tax law. Year 4, he will reverse your accounting depreciation, but because the whole amount is depreciated as per tax law over a period of first 3 years, so there is no depreciation, there is no tax depreciation in year 4. So you can see that taxable profit is 95,000, and this gives us the remaining figures. Then in year 5, the same is the situation as in case of year 4. There is no tax depreciation because as per tax, the whole amount was depreciated during first 3 years. So this is the total situation. Here the important thing is, if we just look at the taxation related to this asset over a period of 5 years, this is 120,000. And profit after tax is 280,000. If we compare it with our accounting figures, so these were our accountant figures. You can see that though in year 1 profit after tax is different from the profit after tax as per tax law, in year 2 profit after tax is different from taxman profit, and likewise in year 3 you can see that here 76,000, here 53,000, in year 4 here 56,000, here 66,000, again here 56,000, here 66,000. But if we see the total column, cumulative effect, we will find that in total, over the life of this asset, the taxation effect is same as per accountant and as per the tax person. And likewise, profit after tax obviously will become same as per the tax person as per the accountant. See, we can note from here, this is only a timing difference. Depreciation expense is being allowed in a different pattern by the tax law, and depreciation is being charged in a different pattern by the accountant. But over the life of the asset, the tax effect will be same. So this means this is only a temporary difference. First, this difference creates, then subsequently it reverses. And at the end of the life of the asset, you will find that taxation related to this asset is the same. As per, like accountant and the tax law calculation will become the same. And we know that this temporary difference is termed as, here we can see that, these are the taxation based on accounting profit, and this is as per the tax law. These are the taxations. Total is the same. Okay. So here, this means this is current tax, in fact. Okay, let me use pen. Before using pen, I should move it to a side. So this is the current tax basically. As we saw at the start of our session, that current tax payable is simply when you apply tax rate to the taxable profit. So that is 17,250. This is the amount which need to be paid to the taxation authority. But in fact, you know that our tax should be 24,000. So again, just recall the accrual concept. Forget about the word defer. Just recall the accrual concept. Like if you have an expense of 24,000, but in fact you are paying only 17,250. So mean you are paying less than your expense. The difference will become your liability. So can I say it liability? Of course, what is the difference?
One of the attendee asking, sir, I cannot get from where this 15,000 came from. Accounting profit was 24,000.
15,000. You are talking about which slide? Okay, let me just find it. 15,000. Okay, just 1 minute. Which 15,000? Can you please ask him? He's talking. Okay, this 15,000.
Yes.
Okay. Who is this gentleman?
Madhya.
Madhya, this is basically we saw at the start of our discussion. Like this asset is being depreciated. This like 20% straight line. So 80,000 is the cost of the asset and residual value is nil. So when you apply this 20% to 75,000 to 75,000, so this will give you 15,000.
Yes.
But yeah, I hope, yeah.
Yes.
Okay. Okay. So this was the 15,000. Okay, we were here. Yes, here. I was discussing like the concept is very simple. See, this is your like expense as per accountant, and we believe in accounting principle. If you incur an expense of 24,000, and while you are paying only 17,250, so what does it mean? This means you are paying less than the amount of expense. So the difference will become liability. For example, if your rent expense is 50,000 and you in fact paid 40,000 to the owner. So this means you paid less than your rent expense. So the difference will become your liability, will become your accrual. The same way, the difference between these two is a liability, is only a liability. That is the difference between these two. If I just use calculator to calculate it, so the difference will become 24,000 minus 17,250, 6750. Because this is the current tax. Current tax people are asking for this amount for whatever reason. Of course, the reason we just discussed, that from tax point of view, in year one, depreciation is a higher figure than from accountant point of view. So this means accounting profit will be a higher amount. So when we apply a tax rate to the accountant figure, so this will give us 24,000. But tax people are asking for 17,250, and plus we know that we will have to pay. Ultimately, we will have to pay 120,000. We'll have to pay 120,000. There is no difference when we look at the overall picture. So this means the difference will be paid at some time into the future. Currently, they are asking for 17,250, but in fact, the liability should be 24,000 which can be seen from the figures in the future, which is very clear from the overall scenario that at the end of the day you will be paying 120,000. So this means the difference is the liability. This is the simple liability as per our accrual concept. Only in order to differentiate this liability from other liability, we mention the word tax, and we attach another word, defer. Why? Because to tell the user that this is a liability related to the tax, but this will be settled at least after 1 year. So this word represents like the time, and this only to specify it, to just name it that this liability related to the tax. Otherwise, this is simply a liability, nothing else. Because we know, we have seen the whole picture in the last slide that this is only a matter of timing, that we are not paying 6750. Ultimately, we will be paying it. Like we can see that here, you can see that as per accountant, this is our tax expense, but tax people are asking for 28,500. So in fact, this amount and the amount which is accumulating in year 2 and year 3 will be reversed in year 4 and 5. So at the end of the day, you will reach at the 120,000 in both cases. So that's why its name is deferred tax liability and nothing else. Like we can see from here, if we just go back to our normal mode, so deferred tax will become 6750, and in this 1125, these are the liabilities, and then 1125, then 4500. This is not liability. This is not liability. This is basically now reversing the liability which is arising in first 3 years, and then 4500, and the net effect is nil. So this means that profit as per tax person may not be equal to accounting profit. Number one. So tax amount based on taxable profit is not equal to the tax as per accounting profit. Cumulatively, profit, tax, and profit after tax are same. So this means all these differences are temporary differences. The total depreciation will remain equal to 75,000, which is the cost of the asset, assuming nil residual value. Now, tax people depreciate this asset differently, whereas accountant depreciate this asset differently. So this affects the profitability from each of them. Okay. So next is what we learned from this example. Like current tax is the amount of income tax payable in respect of taxable profit for a year, which we calculated in year 1, year 2, year 3, year 4, year 5, year 6. And what is the deferred tax? Deferred tax liabilities are the amounts of income taxes payable in future periods. And these were the tax liabilities which we calculated just now. So in a very simple term, if we want to calculate income tax expense, if I just remove the word income tax, mean expense, like I gave you the example of rent of 50,000, where you paid 40,000 to the owner. So if you want to calculate expense, what you will do, you will add 40,000 to the 10,000 of liability, Like if I just use pen over here, see if your total rent is like 50,000, you paid 40,000 cash, you paid it, and so total rent is 50,000. This means 10,000 will be your liability. So this means if we want to calculate what is our expense, so the total of these two figures will be our expense. So likewise, this is the current tax which need to be paid, which is being asked by the tax people. And we know that this amount will have to be paid in respect of profit related to the year one. So when we add up these two figures, this will give us the income tax expense. Likewise, the simple accrual concept, cash paid plus any liability remaining will give you the relevant expense. Likewise here, when you want to calculate year one income tax expense, so you will be adding these two amounts. Income tax expense 24,000, 24,000, 24,000, 24,000. So this will be your expense. In fact, accountant profit and loss account will show income tax expense as a 24,000. This will debit income tax expense 24,000. The second effect will be credited to the two accounts. Deferred tax liability 6750 and current tax payable 17250. 24,000 will appear in the profit and loss account, and it is subdivided into two. Likewise, year 2, year 3, year 4, year 5. So this is with reference to income statement. Okay, now let's see the presentation of the same situation in statement of financial position. While we are discussing these small examples, if you are not clear about any concept which is being discussed, or if you are not like getting any points, so please feel free to ask that question there and then. Because once we move to the next illustration, because a lot of figures are involved, so sometimes it is difficult to explain an earlier point if we are moved too far, and maybe like confusing for the other participants. Okay, let's see from the from statement of financial position point of view. Like, see, our non-current assets carrying value was year one 60,000. Why 60,000? Because 75,000 was the cost, and we reduce it by first year depreciation of 15,000. So this will give us 60,000. Whereas from tax point of view, cost will remain the same, 75,000. But for tax point of view, the tax depreciation rate is 50%. So this means 75,000 minus 50% of the 75,000. From tax people point of view, the value of this asset will be at the end of year one, 37,500. So this will give us a difference between these two figures. And the tax rate is 30%. When we apply this tax rate to 22,500, which is the difference between these two figures, so this will give us the deferred tax liability. This is the same amount as we have seen in year one income statement calculation. Okay, now what will happen? So this is the deferred tax liability for the year. Okay, now come to year two. Here, from accounting point of view, at the end of year two, further 15,000 will be reduced. So this will give us 45,000 carrying value from accountant point. And from tax people, they will reduce 37,500 by 25% of the 75,000 to calculate the carrying value for the tax people point of view. Okay, so this is the difference. And this will give us the deferred tax liabilities 7875. So here, but this figure is different from the figure appearing in the income statement. In the income statement, this was the amount which was appearing, which is 1125. We know from our earlier study, when you calculate deferred tax, yes, when we calculate deferred tax from statement of financial position, this will provide you the closing balance of the deferred tax. Just 1 minute, let me finish with my discussion. And when we calculate deferred tax from income statement figures, this will provide us the for the year deferred tax effect. So that's why when you add these two amounts, you will reach 27875. Okay. Yes.
Muhammad is asking, sir, can you also show double entry for each year?
Yes, why not? Muhammad Hassan. See, double entry for each year will be, let me finish with this slide, then I'll be going back to earlier slide to explain the double entry, no problem. Okay, see here, again, year 3, this asset will be further reduced, 30,000. And from tax people point of view, because at the end of 3rd year, this will become 0. This asset will become 0 because by the end of 3rd year, this asset is fully depreciated from tax point of view. So this will create a difference of 30,000 and this will give us 9,000. Again, we will see that, like this is a cumulative figure. Like if we see in the green line, we can see that if we add up all these 3 items, so this will give us 9,000. So 9,000 is basically the cumulative effect of the deferred taxation. Now, next is basically year 4. Now it started reversing, and year 5. So this is this way deferred tax concept affects statement of financial position. If we go back to the earlier slide, just to explain the entry like for each year, so the entry will be here. Like in year 1, I think I should use a separate. Okay, I can, so that the figure should be in front of you. Like year 1, I can write here for year 1. Entry will be debit income tax expense, income tax expense of 24,000, credit current tax payable 17,250, and then credit deferred taxation. I hope you people can see it clearly. I just want to make sure that the whole data should be available on this slide, instead that we have to move to another empty document. Otherwise, this information will disappear. Okay, year 2. Year 2, similarly, income tax expense. Income tax expense will become same 24,000. 24,000, and the credit will be current tax payable, that is 22,875, and the remaining difference will be credited to the deferred taxation. This was Mr. Hassan who requested this.
Yes.
Okay. So Mr. Hassan, this is number 2. year 2, and the same entry for year 3, because you can see that the same amounts are there. So I'm not repeating for year 3. I'm going directly to year 4. Okay, year 4 is basically debit income tax expense 24,000. Okay, and the credit is current. Yes.
We have one member saying that these are not truly visible to us.
Okay.
Please, change the color of the pen. Beautiful black background, they are not turning.
Okay. Should I use which one?
I think red one.
Okay. So current tax liability is basically, as we can see from year 4, this is 28,500. No, this is the year where deferred tax liability is reversing. So deferred tax will be debited here with the difference, and which is we have already calculated, and that is 45. The same entry will be made in year 5. Hassan, I hope the entry is clear. Someone commented that the color of the pen is not very much visible, so I'll take care of this issue. I hope red is fine. Red is quite visible. So these are the entries. Okay, let's move further. What are the learnings, in fact, from all this discussion? Learning from, okay. So the conclusion is here, statement of financial position gives us cumulative deferred tax position. For the year, deferred tax is the difference between closing and opening, assuming there is no other adjustment. When carrying value is higher than tax base for an asset, another important thing which we learned from here, like here in this case, the carrying value when carrying value is higher than its tax base. This is another small principle which we learned earlier. This will create a difference termed as, of course, this is a temporary difference, we know. But this will be termed as taxable temporary difference. Taxable temporary difference. And when we multiply this difference with the tax rate, so this will give us deferred tax liability. In our last example, we saw that in all years, except last year's, the carrying value of the asset was higher than the tax base. Tax base, we know the value with reference to the tax law. If that value is lower, then the difference will be termed as taxable temporary difference. And when we multiply this taxable temporary difference with the tax rate, this will give us the deferred tax liability. Okay, let's look at the same example, but by changing the depreciation rates for accountant as well as for the tax person. Like accounting depreciation now is 50% year 1, 25% in year 2, and 25% in year 3. Residual value is nil, and assuming profit before tax is 80,000. And whereas capital allowances or tax depreciation is 20% straight line, so we have reversed the in fact situation. Now the tax rate is 30%. Okay, let's see how will it affect. See, from accounting point of view, no change. No, there should be a change. There should be a change from no, there should not be a change because 80,000 is after whatever is the accountant depreciation. Whatever is the accountant depreciation, this is the accounting profit. Okay. So in year 1, the tax person will reverse accounting depreciation, which is in this example 37,500, and reduce the profit with tax depreciation. This will give us taxable profits. When we apply tax rate to these taxable profits, this will give us current tax. This is basically current tax. Okay, profit after tax. Likewise, in year 2, this is the accounting depreciation, and this is the tax depreciation, which is constant for all years. And this is the taxable profit, and 25,125 is current tax payable. Likewise, in year 3, year 4, year 5. We can see that in year 4 and 5, there was no accounting depreciation. So this is the total. Here you can see that the tax cumulative tax is 120,000. So this is basically the current tax payable, which is calculated by applying tax rate to the taxable profits. Okay. So if we just compare it with accountant results, accounting profits, you will see that the cumulative picture is the same. If we look at the total column, we will find that all figures are same from accountant point of view as well as from tax person point of view. What is the difference? The difference is like from year to year, and that difference we know because of difference in the pattern of charging of depreciation. So here you can see that this is the profit after tax from tax person point of view, and this is the profit after tax from accounting point of view. And likewise, you can see that from accountant almost constant profit after tax is appearing. This is just because we have assumed figures in a way. And here you can see that 58,000, then 58,000, 45,000, 45,000. So again, if we just look at it, again, this is the simple principle of accrual. Like this is in fact your income tax expense, 24,000. This is your expense, but tax people are asking for 30,750 for whatever reason, and we know the reason. Because from tax point of view, your profit is higher because their tax depreciation is a lower figure. But from accountant point of view, the depreciation amount is higher figure, resulting in lower profit, lower accounting profit. So that's why when we apply tax rate to the accounting profit, this will provide us 24,000. And but tax people are asking you for a higher figure. Like if we just take a simple example, if your expense is like 70,000, 70,000, and you are paying 80,000. So what about the 10,000? 10,000 will become your prepayment, mean your asset. That 10,000 will become your asset. Here you are paying like how much more than your expense? That is 700. Like if I calculate the difference between these two amounts, you are paying 6,750 higher than your expense. So this will become your asset. Simple. This is your asset. Prepayment, we should normally term prepayment. Just in order to differentiate from other assets, you add the word tax in order to specify it that this is not any other asset. This is basically tax asset related to the tax because we are paying more than we should. So this is just equivalent to the concept of prepayment. So we know that prepayment is ultimately reversed in the form of services or goods. Here, this will be reversed, as we can see from the figures appearing in other in the columns of the other years, that this amount will ultimately be reversed. You will have to pay lower amount in the future years, and this is being reversed. Only you will be adding a word deferred just to show that this amount will be reversed after a period of more than 1 year. Otherwise, this is only an asset. Okay. Likewise, in year, so this is our deferred tax asset. Deferred tax asset. Here it started reversing. So this means, like if we just, what is the current tax? The same as the definition as we saw earlier. Very simple definition. Taxable profit as per the taxman. When you apply it, when you apply tax rate to this figure, this will give you the current tax payable. So these were the current tax payable, and these are the deferred tax assets. So this will give you like income tax expense, which is 24,000. The entry will be here. In year 1, income tax expense debit 24,000. Current tax payable credit 30,750. And deferred tax debit with the difference of 6,750. If I just quickly mention over here, instead of passing entries, if I just quickly mention over here, this will be credit. Sorry. This will be debit. This will be debit. This will be credit. This will be debit. And this will be debit. Likewise, credit. No, deferred tax asset is reverse. So these are the entries which you will be making at the end of each year related to the deferred taxation. Okay, now let's discuss statement of financial position. Here you can see that under statement of financial position, property, plant and equipment for year 1 is 37,500. Because in this example, accounting depreciation for first year is 50%. So at the end of first year, carrying value of the asset after reducing it by 50% of depreciation, 37,500. And for tax people, this will become 60,000 because tax depreciation rate is 20% straight line with nil residual value. So 15% will be the depreciation for the first year, and when we reduce 75,000 by 15,000, this will give us 60,000. Temporary difference is 22,500. Applying 30%, this will give us the deferred tax. And we saw in income statement, you can see that in green 6750 because this is the first year of this asset, assuming there is no other adjustment. So both will be equal. But in year 2, this is the difference. So this will give us 7875. 7875 is the cumulative figure, which is if you add 6750 and 1125. So this will give you the 7850. As we discussed in our example number 1, statement of financial position will give you the cumulative picture, closing balance of the deferred tax, whereas income statement will give you the deferred tax effect for the current year. In year 3, from accounting point of view, because this asset was fully depreciated over a period of 3 years, so this is the difference. This will give you deferred tax in year 4 and then in year 5. So this is as per the statement of financial position. So this gave us position for each year, and this gave us the cumulative position. So here we can see that when in case of asset, if carrying amount or carrying value or net book value is lower than the asset's tax base, this difference is termed as deductible temporary difference. Deductible temporary difference. And when you multiply this difference with the tax rate, so you will reach to deferred tax asset. Earlier, at the end of example 1, we learned when carrying amount of the asset is higher than tax base, this will create a difference termed as taxable temporary difference. And when we multiply taxable temporary difference with the tax rate, that will give us deferred tax liability. And here, this is the second principle. And for liability, you can simply reverse that. You can simply reverse that. Like for liability, if we just reverse it, we go to the next slide. And for liability, liabilities. If liabilities carrying amount is higher than its tax base, and the other situation is when its carrying amount is lower than its tax base. So the difference will be named as deductible temporary difference. And when we multiply this difference with the tax rate, this will give us deferred tax asset. And here, taxable temporary difference. Taxable temporary difference, and when we multiply this taxable temporary difference with the tax rate, this will give us deferred tax liability. We proved it for asset. The same is true for liability. So we must memorize these four principles for like quick application practically as well as theoretically. Okay, what are the definitions, basic definitions? We saw current tax definition, then we discussed deferred tax. Deferred tax is not a current liability to the tax authority, but rather an accounting adjustment. I mean, if you feel that we are paying, or if you calculate that we are paying lower amount than you should, so you record the difference as a liability. If you feel or if you calculate that we are paying more than we should, so the difference will be your deferred tax asset. Because in the future, this excessive amount will be reversed. So this is deferred tax. So deferred tax liabilities are the amounts of income taxes payable in future periods in respect of taxable temporary differences. Deferred tax assets are the amounts of income taxes recoverable in future periods in respect of deductible temporary differences, the carry forward of unused tax losses, and the carry forward of unused tax credits. Okay, so these are definition. Then deferred tax arises because profit before tax for accounting purpose is not the same amount as taxable profit for the taxation purpose. Now there are, or there could be, two types of differences: permanent differences and temporary differences. So far we were talking about temporary differences. As its name suggests, like these are temporary and these will be reversed at some time in the future. But in case of permanent differences, these will never reverse. So deferred tax only arise on temporary differences. No deferred tax will arise on permanent differences. So this is another important point. So far, what we discussed, 4 rules are important. Like when asset carrying amount is higher than tax base, when asset carrying amount is lower than tax base, when liabilities carrying amount is higher than its tax base, when liabilities carrying amount is lower than its tax base. So, mean that difference, what will be the name for that difference? Taxable, deductible, and when we multiply the tax rate with the taxable or deductible difference, so where we reach? These were important rules. And the next is for memorizing is permanent difference will never result in deferred tax. Only temporary difference will result in deferred tax. For example, amount that represents income or an expense for accounting purpose but are not taxable allowable for tax purpose. For example, client entertaining expenses, fines and penalties in some countries. Of course, this varies from country to country, but generally speaking, like if I speak about Pakistan, fines and penalties are basically permanent differences. Tax people never allows these expenses. So this is a permanent difference. Temporary differences, we saw at length the example of depreciation. If depreciation is being allowed at a different rate than the accounting rate, then of course this will create temporary difference. Similarly, if tax people are allowing some of the expenses on a different basis, like on cash basis, so this will also create temporary differences. Overseas dividends that are accounted for when receivable but not taxed until received. Okay. So the next important concept is of tax base. This is the most important concept. The real problem in the life of the accountant is to calculate tax base. Sometimes it is not very difficult, but most of the time it becomes challenging to calculate the tax base because carrying values are already there from your accounting system. Now you have to calculate the tax base. Once you calculate the tax base, the rest of the job is easy. You just need to calculate the difference, and then you will be applying the tax rate to calculate the deferred taxation. So as we discussed in the last session, there is a rule of thumb. There are some, you can say that, like principles which were devised from our practical situations, from the information given in the question. Like if you just keep in your mind those rules, so you can calculate tax base for most of the assets and liabilities. And for the rest, which are not covered under these rules, you can apply the basic definition. Basic definition is simply calculate that asset or liability by applying the tax law. That is the basic definition. What is the rule of thumb? Number one, an account balance related to an income or expense allowed on cash basis, its tax base will always be zero. Number one. Number two, tax base of permanent difference will be equal to its carrying value. This is number two. Like if you, in the balance sheet, if you are applying balance sheet approach, which is recommended by the standard for the calculation of the deferred taxation, and there is a permanent difference either in asset or in liabilities, simply take its tax base as equal to its carrying value. Make your life simple. Okay, number three is, my voice is echoing. Yes.
Sir, Vikas asking, can you please explain carrying amount again?
Vikas, simply carrying amount your net book value or like the value which is appearing in your balance sheet. In case of fixed asset, like cost minus accumulated depreciation, or I mean whatever is the value as per the accountant. So you can name it net book value, carrying amount, carrying value. Vikas, I hope it is clear.
Mohammed Shiraz asking if the carrying value is greater than the tax base, does not that amount to a deferred tax liability and vice versa? Please clarify, sir.
Please repeat it again.
if the carrying value is greater than the tax base, doesn't that amount to a deferred tax liability and vice versa?
You are right in case of asset. You are right.
How can we then account for these permanent differences? Muhammad Hassan. Rule number 1, not understood. Can you please provide example as well?
No, there will be many examples. There will be many examples. Just hold it. Today, we will not be popping up question the way we do, but we will be popping up in a very different way. Like screen will be in front of you. You will be answering that question. And once you people are done with your answer, so I'll be like showing you the answer for that. So a lot of examples will come up. Another question related to tax base of permanent difference will be equal to its carrying amount. See, this standard guides us about the calculation of the deferred tax. When we have identified that this is a permanent difference, so simply it means ignore it. No deferred tax will arise on this difference. By keeping its carrying value equal to its tax base, you are making sure that no difference should arise. I hope it is clear. Number 3, an account balance related to an income or expense allowed as it is, tax base will be equal to its carrying value. Carrying value, again, the value from accountant point of view, the value which is appearing in your account. Number 4, if acquisition or repayment of an account balance does not in itself have any tax consequences, then tax base will be equal to its carrying value. First of all, the tip is, first of all, apply rule of thumb. Otherwise, use the definition. If your like asset or liability does not fall under any of these 4 situations, then straight away go to the definition. Apply the definition of the tax base, and that is like the value as per the tax law. But for those assets and liabilities which are being covered by these 4 principles, straight away you can apply these rule of thumb instead of wasting your precious time. Okay, we can understand or we can discuss these rules with the help of examples. But I would require you to just quickly write down these 4 rules, because when we move to the next slide, by the time if anybody has any question, he can ask that. So please write these 4 rules of thumb quickly, or no problem, we can come back to these rules, but it is better these 4 rules should be in front of you. Okay, let's move further. We'll be coming back to this slide. Okay, this is example number 1. A machine cost 10,000. For tax purposes, depreciation of 3,000 has already been deducted in the current and prior periods, and the remaining cost will be deductible in future periods, either as depreciation or through a deduction on disposal. Revenue generated by using the machine is taxable. Any gains on disposal of the machine will be taxable, and any loss on disposal will be deductible for tax purpose. Calculate the tax base of this machine. Calculate the tax base of this machine.
Usman is 7,000.
Okay, more people should come up with their answer. So what is the tax base? There are two options. Tax base of this machine is 10,000 or 7,000. So please write in the comment box like 10,000 or 7,000. Okay, what are the answers?
7,000 most people saying Vikas, Hashmi, Pranamika, Salam Jalaluddin saying 10,000, and Ali Nagesh 10,000, while rest of the people are saying 7,000.
Most of the people are correct. In fact, this is 10,000. See, very simple. I mean, for those respected members who feel that it is 10,000, see, simply calculate the carrying value of this asset by using the tax law. As per the tax law, 3,000 is the depreciation. So 10,000 is cost. It is very clear. So tax base will be 10,000. Sorry, tax base will be 7,000. Now, another example. Interest receivable has a carrying amount of 1,000. Carrying amount means as per the accountant, which is appearing in the balance sheet. The related interest revenue will be taxed on a cash basis. So let's go back to our earlier slide to see if something is being allowed on cash basis. So what should be its tax base? See, if you just look at rule number 1, if something is being allowed on cash basis, its tax base will be 0. So here, this is an example. So its tax base will be 0. I hope it is clear. So this was an example of
Shazad from nil, and Farhan Laga saying 0. Tax base is 0.
yes, 0.
Yes.
So here we have used rule number 1, where we learned if an asset or liability is being allowed on cash basis, so its tax base will be nil. Now comes to the next. Trade receivables have a carrying amount of 10,000. The related revenue has already been included in the taxable profit. So what is the tax base of this trade receivables? Related to this trade receivable is the revenue. And that revenue is already allowed by the taxation authority. So if we just go back to our rule of thumb, so this is basically rule number 4. Sorry, this is rule number 3. An account balance means account receivable related to the revenue allowed as it is, tax base will be equal to its carrying value. Because trade receivable is a balance, but the related item in the income statement is revenue, and that revenue is being fully allowed. So this means the related asset tax base will be equal to the related assets carrying value. So here in this case, the tax base will be 10,000. So 10,000, because we have entered into an area where we can expect questions. So have you met accounting people? Accounting. Okay. So next is a loan receivable has a carrying amount of 1 million. The repayment of the loan will have no tax consequences. What is the tax base of this loan? Please Submit your answers. This is rule of thumb number 4. This is rule of thumb number 4.
People are saying 1 million, 1 million, 1 million 10,000. By Saqib Ali Rashidi, 0, Muhammad Hassan.
Okay. So if you just go back to this slide, so in fact this is the rule. If acquisition or repayment of an account balance does not in itself have any tax consequences, then tax base will be equal to its carrying. See, when you obtain a loan, that principal amount of obtaining that amount and repaying that amount does not attract or does not have any tax consequences. So for that loan, simply its tax base will be equal to its carrying amount. In simple terms, I'm not talking about instrument or things like that. We will be discussing them separately. But for a simple loan, without any hybrid instrument or anything else, so its carrying value will be equal to its tax base. So this principle will apply on this example, and so the tax base of the loan will be equal to 1 million. Then is the next example: dividends receivable from a subsidiary have a carrying amount of 5,000. The dividends are not taxable. The dividends are not taxable. Okay, what is the tax base? Okay, please
5,000.
write in your comment box 0 or 5,000.
5,000 MD Rehman, who's a 0, 0. Most of the people are saying 0, but Mariam Alauddin 5,000, Zishan Aziz 5,000, Ijaz Mazhar 0, Maria Suhail 5,000, Neil Ijaz Mazhar, Burhanuddin 5,000, Sanaullah 0, Muhammad Kamran 5,000, Atif Bhatt 5,000, Saqib Ali Rashidi 0, Muhammad Bakar 5,000, Salam Jalaluddin 5,000, Mansoor Jadun 0.
Okay, if we just go back to the rule of thumb, see, this is a dividend receivable, an asset, which is not allowed, which is not taxable in fact. This income is not taxable, so this means this is a permanent difference. If it is written that this is not allowed for an expense or for an asset, so that is a permanent difference. I mean, that will never reverse. So this is a permanent difference, and as per rule number 2, its carrying value will be its tax base will be equal to its carrying value. Carrying value as per the accountant. As per the accountant, this is 5,000 dividend receivable. 5,000 will be there, but its tax base will also be 5,000 to make sure no difference arises. In fact, the key concept is. So those who answered 5,000, they are correct. But the important thing is these rules were designed or noted from different practical situations and from the information given in the standard, and after going through different scenarios. So for those situations where you simply see that, okay, this situation is equivalent to any of these rules, so straight away use this rule. So if you see that, okay, this asset or expense is being allowed on cash basis, simply go for rule number 1. Take its tax base as 0. If it is written, okay, this expense or income is not allowed, this means the related asset or liability is also not allowed. So take its tax base as equal to its carrying value. And then if you see that like an asset or liability, for an asset or liability, if the related expense or income, what is the example for that? As we have just seen, like receivable is an asset. Receivable is an asset. And the related item in income statement is revenue. Similarly, like if there is an expense in the income statement, the related liability will be accrued expense. So rule number 3 is if an account balance related to an income or expense allowed as it is, so its tax base will also equal to its carrying value. Similarly, those items which does not have any tax consequences, the typical example is loan. You take a bank loan. Of course, interest has got some tax consequences, interest on that particular loan. But so far as the principal amount, receiving that amount and repayment of that amount will not have any tax consequences. So tax base of such item should be equal to its carrying amount. When we say tax base should be equal, we are in fact saying like no difference should arise. Okay, so these were the examples. Then there are a few more examples, like okay. Another example is current liabilities include accrued expense with a carrying amount of 1,000. The related expense will be deducted for tax expenses on a cash basis. Okay, give me the answer. So I would prefer that you just recall the rule of thumb. There is an accrued expense, and that expense is allowed on a cash basis. So what is the tax base of that expense, that accrued expense?
Most of the people are saying 0. 0, 0, 0, 0.
Very right. So its tax base is
1,000.
Dishan, please, Dishan, apply that rule of thumb, so you will be reaching to this amount. Okay, then the next example is current liabilities include interest revenue received in advance with a carrying amount of 10,000. The related interest revenue was taxed on a cash basis. Please come up. Write your answer in the comment box.
Again, people are saying 0. M. Babur Khattak 10,000. Sumra Askar 10,000. Khurram Rashid 10,000. But other people are saying 0.
Most of the people are saying 0. Most of the people are correct, because simply again this is only a replication of the first example. See, this is an item which is allowed on a cash basis, so its tax base will always be 0. Okay.
So this time Zishan says 0.
Good, Zishan. Good. Simply Zishan, instead of reinventing wheel every time. So because we have already invented these rules, so it is better take advantage of those rules. So far as its proof is concerned, you can apply your mind and you can go for like its proof. But if you know something, if you know some rule, so it is better apply that rule straight away. Current assets include prepaid expenses with a carrying amount of 2,000. The related expense has already been deducted for tax purposes. So what is the tax base for this? Please, 0 or 2,000? Come up. Come up with your answers.
2,000, 2,000, 2,000. Most of the people saying 2,000.
So
for 2,000 is
2,000 is correct. Very right. This is the example of that rule where you want to determine the tax base of an asset whose related item is being allowed in income statement. So it will be equal to its carrying value. Then another example, current liabilities include accrued fines and penalties with a carrying amount of 100. Fines and penalties are not deductible for tax purposes. So what is the tax base for this? So this is example of permanent difference.
100 people are saying. People are saying 100 mostly. Bobber Hatak 0. Mariam Alauddin 100. Mathur Jadon 100. Mostly people.
100 is correct. Because this is the permanent difference. And its tax base will be equal to its carrying value, which is 100. And then is a loan payable has a carrying amount of 1 million. The repayment of the loan will have no tax consequences. What is the tax base? 0 or 1 million?
Zero. Bobber Hatak 1 million. Shadad 1 million. Sohail 1 million. Ijaz 1 million.
1 million is correct. So this is rule of thumb number 4, in fact. It is clearly written that repayment of the loan will not have any tax consequences. This means there should not be any difference. To make sure there should not be any difference, take its tax base as being equal to its carrying amount. So now we shall be having a break, and after break we shall be resuming our session. Okay. Welcome back. We were discussing tax base. Few more examples. See, a borrower records a loan at proceeds received, amount due at maturity less transaction cost. The carrying amount of the loan is subsequently increased by amortization of the transaction cost against accounting profit. The transaction costs were, however, deducted for tax purposes in the period when the loan was first recognized. A loan payable is measured on initial recognition at net proceeds, net of transaction cost. The transaction costs are amortized to accounting profit over the life of the loan. Those transaction costs are not deductible in determining the taxable profit of future, current, or prior periods. The liability component of compound financial instrument, that is a convertible bond, is measured at a discount to the amount repayable on maturity after assigning a portion of the cash proceeds to the equity component. The discount is not deductible in determining taxable profits. Current investments or financial instruments are carried at fair value. This exceeds cost, but no equivalent adjustment is made for tax purpose. And likewise, property, plant, and equipment is revalued by an entity under IAS 16, but no equivalent adjustment is made for tax purposes. This also applies to long-term investment. Okay, now let's make it simple, and we shall be discussing this compound financial instruments at length with the help of an illustration, how you can treat deferred tax related to the compound financial instruments. First of all, see, this is simple. Your investments. For tax people, they will be taking it as tax base. And likewise, property, plant, and equipment, when your policy is to apply revaluation model, but tax people will normally continue to apply cost after reducing that cost by the tax depreciation. We shall be discussing on it in a while. Similarly, loan payable is measured on initial recognition at net proceeds, and these transaction costs are not deductible in determining the taxable profit of future, current, or prior periods. So accordingly, this will affect its tax base. Okay, let's discuss compound financial instrument. Compound financial instrument. So this example, this illustration is, I hope, available with you people. This illustration is uploaded on GoToWebinar and also on Google Doc. So it is better you should download this illustration so that it should be in front of you. The illustration material is in front of you while we are discussing its solution. Compound financial instruments. See, an entity received a non-interest bearing convertible loan of 1,000 on 31st December 2014. Repayable at par on 1st January 2018. The entity classifies the instrument's liability component as a liability and the equity component as equity. The entity assigns an initial carrying amount of 751 to the liability component of the convertible loan and 249 to the equity component. Subsequently, the entity recognizes imputed discount as interest expense at an annual rate of 10% on the carrying amount of liability component at the beginning of the year. The tax authorities do not allow the entity to claim any deduction for the imputed discount on the liability component of the convertible loan. The tax rate is 40%. Calculate the temporary differences associated with the liability component and the resulting deferred tax liability and deferred tax expense and income for the years 2014, 15, and 16. Okay, so let's have a. So I hope while I was reading this illustration, you must have downloaded this illustration from GoToWebinar or the Google Doc, so that when I move to Word doc for the discussion of its solution, so this should be in front of you. This illustration should be in front of you as a reference so that you could see any figure if you want. Okay, so 2014. Say, let's discuss with the help of statement of financial position. Statement of.
So this illustration will be available in, I think, illustration number 1.
This is illustration number 3. You want to see which one is mean? Are they facing any problem in downloading it?
No.
See, this is basically they can go to, where are the handouts?
The upper one.
These are the handouts. Okay, they can go to, where are those? Okay.
1, 2, and leases.
I suppose it should be within the leases, because I included this illustration, because here I included special cases. Yes, you can find this illustration in a document named leases, but illustration number will remain the same. Illustration number will remain the same. Illustration number is 3. Okay, let me go back to where we're. Okay. Statement of financial position. Financial position for as at 31st December 2014. Okay. So carrying value. Carrying value means as per accountant, as per your accounting record. Carrying value. Carrying value. Then we can make another column for tax base. Tax base. Tax should be red. Tax base. And then there is a difference. Then there is a difference, which could be taxable or deductible temporary difference, and then deferred tax. Deferred tax. Okay, so under non-current liabilities, non-current liabilities, under non-current liabilities, we shall be having this liability component of convertible, liability component. And if we just go back, so here it is liability component 751, and this was issued on 31st December 2014. mean at the year end, and we are at the year end. Sorry. And this is now the carrying value 751. It is from here. This is 751, and this convertible loan was issued on 31st December 2014. Okay. Okay, let me change its mode. It's 2. Okay, this is the carry. Now, what is the tax base? For tax people, the amount which you have actually received. This is their law. They do not know your accounting, like bifurcating the equity and the debt component, and recognizing a part of that amount which you received as a equity component. I mean, tax people normally do not understand. So this means the difference will arise to 49. So when we apply tax rate, so this will give us the deferred tax liability. As we learned the rule, like this is basically the liability, and if carrying value is lower than the tax base, the deductible temporary difference, taxable temporary difference will arise, and when we apply tax rate to that taxable temporary difference, so this will give us the deferred tax liability. So this is your deferred tax liability. Okay. Then this will not affect your profit computation. Why? Because this instrument was issued on the last day of year 2014. Okay. So our entry will be, like if we take into account the deferred tax liability, so our initial entry should be debit bank where we receive the money 1,000, credit liability component 751, credit deferred tax liability, which we calculated 100, and credit equity element. In this case, 149. So this is the entry if you are residing in a country where tax is applicable. But if you are in a country where there is no tax, so simply ISA 12 is not applicable, so you do not need to bother about it. Okay, now let's have a look at the next year. Next year, 2015, statement of, do we have any question?
So far,
okay, statement of financial position. Statement of financial position as at 31st December 2015. Next year. Next year, what happened? Like the same column, we can make like carrying amount, which is the amount as per the accountant. Then is the tax base. then the difference, and then deferred tax. Okay. So here again your debt component under the non-current liabilities, and now 1 year is passed, so you might have included in it the effect of interest at the rate of 10%. So this will become 826. How we calculated it? It is calculated like 751 at the end of 2014 into 1.1, which is the effective interest rate, which is given over here. This is annual rate. Okay. Okay. So tax base will remain 1000. The difference is 174. When we multiply tax rate with 174, this will give us the 70. So what we will do with 70? We shall pass an entry, debit, profit, debit, just 1 minute, debit, profit and loss, okay. So this is in fact deferred tax liability of how much? Yes, deferred tax liability is decreased by 30. Deferred tax liability is decreased by 30. Here you can see that its opening balance was 100 in 2014. Deferred tax liability was 100, and now in 2015 the deferred tax liability is 70. So it is reduced by 30. This reduction will go to the profit and loss. Because liability is reducing, deferred tax liability debit and profit and loss account credit. So this is the entry for 2015. Now comes to the 2000.
Sir, Madiha asking why equity is reduced to 149 from 249.
See, Madiha, basically equity is the balancing figure. And we know because we recognized this loan instead of 1000, we recognized it as 751. So this will create a temporary difference, because once you keep on unwinding the interest, so that will ultimately become 1000, but there is a temporary difference. So that temporary difference will create deferred tax liability. Okay, similarly in 2016, if we just change its color and we see that what in 2016 the debt component will become 909. Same way, when we multiply this with 1.1, this will give us 909. But from tax people point of view, this is 1000. Again, 90, a difference of 91 will appear, and 37 is basically our deferred tax liability closing balance. So it is opening balance was 70, and so the difference between 37 and 70 is basically 33. So this 33 will again be debited to the deferred tax liability and credited to the profit and loss account. This way you can account for deferred taxation effect on your compounding instrument. Okay, so now move to the next. Next is basically leases. See, for leases, Though here I have mentioned International Accounting Standard 17, but in fact the same principle will apply under IFRS 16. See, if we talk about finance lease, if we talk about say finance lease, under finance lease, what we do, we normally recognize that asset in the balance sheet, on the balance sheet, and likewise we recognize the respective liability in the liabilities, of course, bifurcated into the non-current element and the current element. So in case of finance lease, tax authorities allow periodic lease installment as an expense for that period, whereas IFRS 16 requires the installation to be bifurcated between finance cost and the repayment of lease obligation. This difference of treatment will create deferred tax. Tax base of account balances appearing in the statement of financial position will be 0. See, if we apply statement of financial position approach, so here you can see that. So this will be your lease asset. This is your lease obligation non-current portion. This is lease obligation current portion. But for tax point of view, they do not take it as your asset because it is not owned by your organization. So they take this asset as a 0 because they take it if you have taken this asset on rent. So if you have acquired an asset on rent, because this is not owned by your organization, so this is not your asset as per the tax law. So that's why the lease asset from tax people point of view will be 0. So accordingly, because they are allowing you the lease installment as an expense whenever you pay as a rent expense, so they do not recognize these liabilities as well. So from tax point of view, the tax base of lease asset and the lease obligation will be 0. This will be 0. So this will create temporary difference. So you can calculate the deferred tax effect by simply filling this pro forma related to your leased assets. Or if you want to apply income statement approach, because balance sheet approach will give you the closing balance, will give you the cumulative effect of a deferred tax in relation to your leases. But if you want to calculate for the year effect due to leases, so this pro forma can be used. See, assuming there are no other adjustments, then see, this is your accounting profit before tax. Now, tax people will add back depreciation on your leased asset because they do not consider it as your asset. Then they will add back your finance charge. They simply allow you the lease payment as a whole. So this will give you the taxable profits. So when you apply this taxable profits, when you apply tax rate to these taxable profit, this will give you the current tax payable. Current tax payable, and then you can calculate your deferred tax effect. Okay, we can understand it with the help of this small illustration. This illustration is also available with you people. This illustration is basically Mars Limited. Mars Limited is engaged in the manufacturing of chemicals. On July 1st, 2008, it obtained a motor vehicle on lease from a bank. Details of the lease agreement are as follows. Cost of motor vehicle is 1.6 million rupees. Installment of 480,000 are to be paid annually in advance. The lease term and useful life is 4 years and 5 years respectively. The interest rate implicit in the lease is 13.701%. ML follows a policy of depreciating the motor vehicles over their useful life on the straight line method. However, the tax department allows only the lease payment as a deduction from taxable profits. The tax rate applicable to the company is 30%. ML's accounting profit before tax for the year ended June 30th, 2009 is 4.9 million. There are no temporary differences other than those evident from the information provided above. So this is the illustration, and this is also available, as I mentioned earlier, on GoToWebinar. So anyone who has not yet downloaded this handout, I suppose named leases, so they should, because while we discuss deferred taxation implication for this leasing transaction, so it is better the original illustration should be in front of you. Okay, see, if we just go to our earlier slides, how can we calculate? Okay, this is the first year. What is the amount of the leased asset? The amount of the leased asset is 1.2 million. How we calculated it? We know that like the cost of this asset is 1.6 million and its useful life is 4 years, lease term and the useful life. And we know from IFRS 16, if like there is no reasonable certainty that the asset will be acquired, you depreciate that asset over the load of useful life and the lease term. So here lease term is 4 years. So without going into like much detail, we have depreciated this asset over a period of 4 years. 1.6 million was the cost of this asset, and when we depreciate this asset over a period of 4 years, so first year depreciation will become 400,000. So at the end of first year, the carrying value of this asset will become 1.6 million minus 400,000, 1.2 million. So this is the carrying value of this asset. Likewise, liability will be calculated. So liability will be like if we just, instead of bifurcating into two portions, we have just calculated, for example, 1, 2, 0, 0. How we calculated it? Simply because I just want to move to another one. So just we calculated it like tax lease installment was 480,000 are to be paid annually in advance. So when we reduce 1.6 million by this advance and then apply the interest rate of 0.13701, so this will give us 153,512 as interest expense. Okay, let me explain over here. We are paying 480,000 in advance. So this means before paying this advance, our lease obligation was 1.6 million. It is 6 in fact. So right at the start of lease, our lease liability is reduced to 1120. And thereafter, when we calculated the finance charge on this lease at the rate of 13.70%, so this will comes to 153 and 451. So total liability will become 45137. I suppose you can check it. Okay, let me check this as well. Plus 1,273,451. Okay, fine. So here we have written it separately. This is the lease obligation, and including both current and long term, and then finance charge. I can use this line for finance charge. So this will be your finance charge, accrued finance charge, and that is 153,451. This is negative. This is a liability. This is also negative. So these are the amounts which will appear in your statement of financial position in relation to this lease. So you can see that tax base of this amount is 0. So the temporary difference will become this. And this is what? This is basically taxable temporary difference, because we learned the rule that if carrying value is higher than the tax base, then this will create taxable temporary difference. And so this is taxable temporary. I will mention here T. So here this is liability. Liability is higher than the tax base. Carrying value of the liability is higher than the tax base. So this will create a deductible temporary difference. So I can show deductible temporary difference in negative. So this is deductible temporary difference. And likewise, its tax base is again 0. So again, this will create a, because they do not allow this finance charge, they simply allow you as allow that lease rental as an expense. So when we net off all these three figures, so this will give us taxable temporary difference, because these two figures, sum of these two figures is lower than 1.2 million. So we will end up with a taxable temporary difference, which is 73451. 73451. This is taxable temporary difference. When we apply tax rate, that is 30%, I suppose. Yes, 30%. So this will give us deferred tax. Deferred tax. Let me check. Yes, no. This is deductible temporary difference, because 11,20,000 plus 153,000. The sum of these two figures is higher than 1.2 million. So this is basically deductible. I should mention over here, deductible temporary difference when I apply 30% to this amount. So this will give us a deferred tax asset. This is a deferred tax asset. Okay, the same amount can be like calculated from the income statement as well. So this is the deferred tax asset in relation to your lease transactions. Simply remember that in most of the countries, the tax base of these lease assets and liabilities and related finance charge will be 0. So straight away, this will give you the difference. So see what is the net effect. Is it taxable temporary difference? Is it deductible temporary difference? So then apply the tax rate to calculate your deferred tax liability and deferred tax or deferred tax asset. Okay, so its entry will be for this, because this is the first year, so its entry will be debit deferred tax account asset with the 2035 and credit profit and loss or income tax expense, you can name it, 22,035. So you will make this entry. Because this is the first year, the same amount will appear if you want to calculated from income statement. Okay, 22,035. So this is related to the leases. Okay, next is you can apply this, so you will be reaching the same amount. This was the illustration which we tried to solve. Now, next is share-based payments. See, in accordance with IFRS 2, share-based payments, an entity has recognized an expense for the consumption of employee services received as consideration for share option granted. A tax deduction will not arise until the options are exercised, and the deduction is based on the option intrinsic value at exercise date. As per the standard, the difference between the tax base of the employee services received at date being the amount the taxation authorities will permit as a deduction in future periods in respect of those services, and the carrying amount of nil is a deductible temporary difference that results in a deferred tax asset. If the amount of the taxation authority, if the taxation authority will permit as a deduction in future period is not known, if you don't know what is the amount that will be allowed by the taxation authority in the future period, then it should be estimated based on information available at the end of the period. If the amount that the taxation authority will permit as a deduction in future period is dependent on the entity's share price at a future date, the measurement of the deductible temporary difference should be based on the entity's share price at the end of the period. If the tax deduction or estimated future tax deduction exceeds the amount of the related cumulative remuneration expense, this indicates that the tax deduction relates not only to the remuneration expense but also to an equity item. In this situation, the excess of the associated current or deferred tax should be recognized directly in equity. So this is a small format which you can use while calculating deferred tax asset of share-based payment. Carrying amount of the share-based payment expense 0. Tax base you can estimate it as per the principle which I just discussed. If the amount of the tax deduction, as I said earlier, exceeds the amount of the related cumulative remuneration expense, this indicates that the tax deduction relates also to an equity item. The excess is therefore recognized directly in equity. Okay. These were, in fact, individual transactions. How these transactions affect deferred tax. Now let's try to look at big picture with the help of illustration 1. This is also available with you people. This is illustration number 1, and this was sent in the form of handouts. It is in the downloadable form. Illustration number 1. Okay, this is the illustration number 1. Okay, first of all, let us read this illustration. This illustration is, you can see that this is a complete statement of financial position. Statement of financial position of Nisha Limited for the year 2004, 2005, and 2006. Here I have taken only 2005 so that I could make use of the space available after 2005 for the calculation for the solution of this comprehensive example. Accounts payable, inventory, product development cost, investment, property, plant and equipment, and then current income tax payable, accounts payable, fines payable, liabilities for healthcare, long-term debt, deferred tax income, share capital, devaluation surplus, retained earnings. Okay, the other information is income tax rate. Income tax rate in 2005, 40%, 2006. I suppose it should be like 2004. We need 2004 in fact. 2004. Yes, it will be here. It should be here. Yes, 2004. That was 2005 in fact. Okay, so this is the information. Income tax rate 2004, you can take 40%. Mean income tax rate for both here as 40%. And please make this small change. Charitable donations are recognized as expense when they are paid and not deductible for tax purpose. Company paid donation $500 in 2005 and $350 in 2006. In 2005, liability of $700 was recognized as fine, which is not deductible for income tax purpose. Then is okay, no payment. Okay, product development cost is deductible in tax on cash basis. In 2002, 1,250 were incurred. These are amortized over 5 years. No payment regarding healthcare facilities was made in 2005 and 2006. These are deductible in tax on cash basis. Then they have given us, like for 2004, they have given us cost of both assets, and they have given us accumulated depreciation on this date for both assets and for tax depreciation for both assets. So from this we can calculate tax base of the property, plant and equipment at 31st December 2014. Similarly, there is an information related to 2006. See, here we will mention, so this I suppose that this illustration is in front of you, so I will focus that area where we need to include our answer. Okay, let me check this. Okay, now it has become normal, so I should go back to here. It is not allowing. Why? Why can't I write it? Okay, if I use a pen over here, so I write something, but if I moved out of this mode, then I can come over here and try to open this view, but it is not allowing. So, okay, I do accept.
No comment or track change.
Okay, but to reject and move to others. Okay. No, it is restricting editing. Editing restrictions start in person.
You want to write this time? Okay, it
Yes.
has started.
Okay, now it is. Started. Okay, fine. So we want to close this as well. Okay. See, account receivable. Its tax base will be 500. There is no other information, but in the absence of any other information, its tax base will be 500 because, as per rule of thumb, its related revenue is allowable for tax purposes. Nothing is mentioned, we can safely assume that. So its tax base will be equal to. Then inventory. Nothing is mentioned because the related expense, cost of sale, is allowable for tax purpose. So its tax base will be equal to this. So far as the product development is concerned, there is an information about product development. It says product development cost is deductible in tax on cash basis. Simply, we know that if something is allowed on cash basis, its tax basis 0 from our rule of thumb. Then investment, and from our slide, like from this slide, we know that investment tax base, if it is not at fair value, so it will be cost. Or our measure at fair value, this exceeds cost. So cost will be the tax base for it. Then property, plant and equipment information is given. Like for property, plant and equipment, this 36,000 is the carrying amount. We need to calculate its tax base. Information is in front of you. You can see that building cost is 50,000. Building, say if I mention here building, and then there is a motor vehicle. Building cost is 50,000. Motor vehicle cost is on what date? On the date of this balance sheet, 2004. 50,000, and motor vehicle cost is 10,000. And on the same date, information is given so far as the accumulated tax depreciation is concerned. That is provided as 40,000, and for motor vehicle it is given as 5,000. So this will give us net book value from tax point of view 10,000, and here the net book value will be 5,000. When we add up, so this will give us the tax base for property, plant and equipment. Further the tax base of payable, current income tax payable, so we are ignoring it. And then account payable, in the absence of any information, because this account payable is related to the expenses, and we are assuming that expenses are already allowed for tax purposes. So any item which is appearing here in balance sheet, its tax base will be equal to its carrying value. And then there is no fine payable, so ignore it. So this is long-term debt, so its tax base will be equal to its carrying value, because as per rule number 4, it has got no tax consequences. Then this is the figure which should be our answer, in fact, because we are trying to calculate from the assets and the liability. And this is the figure which should be calculated from taxable profit. And this is the figure which should be our answer, because while preparing this balance sheet is complete and it has already got the effect of the deferred taxation, but we are trying to calculate it separately. Okay, ignore equity, because deferred tax asset and liabilities here in this case, in the absence of other information, relates to the assets and liabilities. So here we can see that the difference, no difference, no difference, and there is a difference of 500, no difference, and there is a difference of 21,000, and no difference, and so the total. Now you can see that here the carrying value of the asset is higher. So this was basically the taxable temporary difference. This was the taxable temporary difference. So this will give us. In total 21,000. Let me check, is it correct? 36,000 minus 15,000. So it should be, yes, 21,000 plus 500 plus 500. So this will, total taxable temporary difference will be 21,500. And when you multiply it with 40%, which is the tax rate, so this will give you the deferred tax liability of 8,600, which is given over here. So this way you can calculate cumulative deferred tax liability from the balance sheet. Okay, now let's move to 2005. See here, it is 2005. Now for 2005, 86,000 is the opening balance. 86,000 is the opening balance. So we shall take 86,000 as an opening balance, and then we move further. Here we have all the accounts. Okay, fine. So here again we calculate the tax base. Good. Now it is allowing us, but without any color. They want us to use only. No, there are options.
So many colors.
Okay, good. Okay, tax base. Tax base. Okay, take it as tax base. So 500 is the tax base for the same reason which we discussed. No information is provided. So we are assuming that, of course, the related revenue is allowable, already allowed in income statement. So this is the asset related to that income. So as per rule of thumb, so the tax base will be equal to its carrying value. This is the carrying value as per the account. Likewise, for inventory, product development cost for the same reason, because this is allowed on cash basis, so its tax base will be 0. For investment, we know this is at cost. So had it been at fair value, so we would have taken cost as its tax base. Now, for property, plant and equipment, we shall have to calculate the carrying value as per the tax authorities. So how can we calculate? We know that what are the cost and the accumulated depreciation from at the beginning of 2005. Like for building, and then we have motor vehicles. Cost is for building, it is, let me check. Okay. For building, the cost is 50,000. Motor vehicle, it is 10,000. Then there is addition. This is the situation on 1st January 2005. And we are going to calculate with reference to the tax authorities, because so far as the accountant is concerned, this value is there. This is the carrying value as per the accountant. So the tax rates are given. Let me check, is there any addition? Yes, there is an addition of 6,000 in building. There is an addition of 6,000 in building. This is the addition, and at the end of year, 56,000 is the cost of building, and 10,000 is the cost of motor vehicles. Now, these are the costs at 31st December 2005. Now, accumulated depreciation. Depreciation. We know accumulated depreciation on 1st January 2005 was the opening or closing of 2004, 40,000 and 5,000. And then we add in these amounts depreciation for the year. As it is mentioned in the question, like for building, 10% straight line. So for the year, depreciation will be 5,600. And 25% of the motor vehicles, straight line. So this will be 2,500. So when we add up these two amounts, this will give us accumulated depreciation on 31st December 2005 from tax point of view. So this will give us 46,500, and this will give us 7,500. So these are the costs, and these are the accumulated depreciation. If we total these two figures, so this will give us 66,000. This is the total cost of the fixed asset, and if we total these two figures, this will give us 45,600, 7,500. This will give us 53,100. So when we net these two figures, this will give us the tax base of property, plant and equipment. 12,900. So 12,900 we shall mention it over here. So this is the tax base of property, plant and equipment. Then this element will be calculated from income statement. So we are ignoring it. So for account payable, same reasoning, its tax base will be 0, like related expense is assumed to be allowed by the tax authorities. Fines payable. So fine is not allowed. This is permanent difference. For permanent difference, tax base will be equal to its carrying value. And then liabilities for healthcare, we have seen for liabilities of healthcare, it is said that these will be allowed on cash basis. So something which is allowed on cash basis, its tax base will be 0. Long-term debt, nothing is mentioned. So this is something of which, like, this has no tax consequences. Its tax base will be equal to its carrying amount. So this is the amount which we want to calculate in fact. So okay, so temporary difference, no temporary difference, no temporary difference, and 250. So this is, we know that this is taxable temporary difference because carrying value of the asset is higher than its tax base. No difference. Again, there is a difference. 37,200 minus 12,900. So this gives us 24,000. 24,300. Again, we can see that here carrying value of the asset is higher than the tax base. So this is taxable temporary difference. Then there is no difference. Then there is no difference. And then again, 2,000 is the difference. But here liability is higher than its tax base. So this is deductible temporary difference. So if we just add up, net all these figures, so this will give us plus 250 minus 2,000. So this is 22,560. So this is in fact taxable temporary difference. When we multiply the tax rate, which is 40%, I suppose. So this will give us 9020, 9020, which is already calculated over here. And we perform these calculations just to verify this. 9020. Okay, now we can have a few minutes break, then we can come back. Okay, so this is the way we can do calculation of the deferred tax from balance sheet, and we know that this will give us the cumulative picture. So if we just look at look at the solutions of some of the the example which we have seen now. So similarly for 2006, you can see that this was for 2005. So you can see that here is the effect of the revaluation in 2006. But in this figure, there is no effect of revaluation, because normally in most of the countries, tax authorities do not follow accounting principles. So revaluation is the concept of IFRS. So if tax law does not incorporate this concept, then of course tax base will simply be based on tax depreciation. So this will become your difference. And here again, healthcare is being allowed on cash basis, so tax base 0. Fines and penalties not being allowed, so straight away this is a permanent difference. Its tax base will be equal to its carrying value. So this will give us 0. So this is the way we can do with the balance sheet. Okay, now come back to our slides. Okay, now business combinations. In business combinations, here are circumstances which give rise to taxable temporary difference. This is important. Taxable temporary difference. This will result in deferred tax liability. This will result in deferred tax liability. The carrying amount of an asset is increased to fair value in a business combination that is an acquisition, and no equivalent adjustment is made for tax purposes. This change of fair value is not accounted for by tax people. Then unrealized losses resulting from intragroup transactions are eliminated by inclusion in the carrying amount of inventory or property, plant, and equipment. These are eliminated. So this will result in taxable temporary difference. Retained earnings of subsidiaries, branches, associate, and joint ventures are included in consolidated retained earnings, but income taxes will be payable if the profits are distributed to the reporting parent. Likewise, investment in foreign subsidiaries, branches, or associate, or interest in foreign joint foreign joint ventures are affected by changes in foreign exchange rates. So this will also create taxable temporary difference. An entity accounts in its own currency for the cost of the non-monetary assets of a foreign operation that is integral to the reporting entity's operations, but the taxable profit or tax loss of the foreign operation is determined in the foreign currency. Then other situations are the same fair value adjustments, unrealized losses, then consolidated earnings, changes in exchange. This is only a repetition of the earlier material. Circumstances that give rise to deductible temporary difference. A liability is recognized at its fair value in a business combination that is an acquisition, but none of the related expenses deducted in determining taxable profit until a later period. Unrealized profits resulting from intragroup transactions are eliminated from carrying amount of assets, such as inventory or property, plant or equipment, but no equivalent adjustment is made for tax purpose. No equivalent adjustment is made for tax purpose. Investment in foreign subsidiaries, branches or associates or interest in foreign joint ventures are affected by changes in foreign exchange rates. A foreign operation accounts for its non-monetary assets in its own functional currency. If its taxable profit or loss is determined in a different currency under the presentation currency method, changes in the exchange rate result in temporary differences. The resulting deferred tax is charged or credited to profit or loss. Then this is again the repetition. We can look at two small illustrations with the help of its answers. Illustrations are: you are the accountant of an entity. Your assistant is preparing the consolidated financial statements for the year ended 31st March 2022. However, he is unsure how to account for the deferred tax effects of certain transactions as he has not studied IAS 12. These transactions are given below. Transaction 1: during the year, the entity sold goods to a subsidiary for $10 million, making a profit of 20% on selling price. 25% of these goods are still in the inventories of the subsidiary at 31st March 2022. The subsidiary and the entity are in the same tax jurisdiction and pay tax on profits at 30%. Then transaction number 2, an overseas subsidiary made a loss adjusted for tax purposes of $8 million. The only relief available for this tax loss is to carry it forward for offset against future taxable profits of the overseas subsidiaries. Taxable profits of the overseas subsidiaries suffered tax at a rate of 25%. See, in this illustration here, you can see that there is an unrealized profit. So when while preparing consolidated financial statement, when you will account for this unrealized profit, so this will create a taxable temporary difference, as we can see from its answer. The intra-group sale will give rise to the provision for unrealized profit on the unsold inventory of 10 million into 20% into 25%. Because if you just go back, you can calculate, like it is given over here, like 25% of this inventory, I mean 250,000 inventory, and profit was on selling price. So this basically reflect this 25% when you apply on this figure. So this will give you the inventory lying in your stock, and when you apply this 20%, this will give you the profit on this stock. This provision must be made in consolidated accounts. However, this profit has already been taxed in the financial statement of the entity. In other words, there is a timing difference in the following year. When the stock is sold outside the group, the provision will be released. Okay, the provision will be released, but the profit will not be taxed. The timing difference therefore give rise to the deferred tax asset. The asset is 30% multiplied to the unrealized profit on stock, which is the, in fact, temporary difference. Deferred tax assets are recognized to the extent that they are recoverable. This will be the case if it is more likely than not that suitable tax profits will exist from which the reversal of the timing difference giving rise to the asset can be deducted. The asset is carry forward on this assumption. Now, on the transaction number 2, an unrelieved tax loss gives rise to a timing difference because the loss is recognized in the financial statement but not yet allowed for tax purpose. When the overseas subsidiary generates sufficient taxable profits, the loss will be offset against these in arriving at taxable profits. And this will create a deferred tax asset of 2 million. As in case of transaction 1, we have seen that there are certain certain criteria should be there before that deferred tax asset could be recognized. Okay, then disclosures. There are a number of disclosures like you need to disclose a major component of tax expenses, including current tax expense, any adjustment of taxes of prior periods, amount of deferred tax expense relating to the origination and reversal of temporary differences, amount of deferred tax expense relating to changes in tax rates or the imposition of new rates, amount of the benefit arising from a previously unrecognized tax losses, tax credit, or temporary difference of a prior period, write down or reversal of a previous write down of a deferred tax asset, amount of tax expense income relating to changes in accounting policies and correction of errors. Further, disclose aggregate current and deferred tax relating to items recognized directly in equity, tax relating to each component of other component income, explanation of the relationship between tax expense and the tax that would be expected by applying the current tax rate to accounting profit or loss. And then changes in tax rate need to be disclosed, amounts and other details of deductible temporary differences, unused tax losses, and unused tax credits. Similarly, temporary differences associated with investment in subsidiaries, branches, and associate, and interest in joint ventures. And likewise, tax related to discontinued operations, tax consequences of dividends declared after the end of the reporting period, information about the effects of business combination, and the tax consequences of future dividend payments. These are the main disclosures relating to this standard. If we have any question, you can ask.
We have a question from Baba Patel. Could you please shed light on recurring tax losses which are carried forward and often recorded as deferred tax asset? I think that the nature of that kind of deferred tax asset is different from the one that you discussed that emerges out of temporary differences. Please correct me if I am wrong.
No, Baba Patel, if you just look at the deferred tax asset definition, so you will find that both are the same. Like we have here deferred tax asset definition, I suppose it is here, deferred tax asset. Here you can see that deferred tax assets are the amount of income taxes recoverable in future periods in respect of deductible temporary differences, the carry forward of unused tax losses, and the carry forward of unused tax credits. Like deductible temporary difference mean like unrealized profit on stock. So, but deferred tax asset can also arise, and the treatment will be the same. Like you need to look at your future results. If these will be reversed, then only then you should recognize this asset. For asset, we are prudent so far as its recognition is concerned. Next.
Okay, Mohammed Shiraz Asfar. If the carrying value is greater than the tax base, does not that amount to a deferred tax liability and vice versa? Please clarify, sir.
Can you repeat the question? Shiraz. What is the question?
If the carrying value is greater than the tax base, does not that amount?
If the carrying value is greater than the tax base,
does not that amount to a deferred tax liability?
You are right.
Okay, how can we account for these permanent differences?
No, simply mean this will not result in any deferred tax. This will not create any deferred tax. Simple. No other treatment.
Okay, Usman Yusuf asking, what are the implications of permanent differences?
Usman, permanent differences are those differences which are not permanent, which are permanently disallowed. So their implication is that there is no implication so far as the deferred tax is concerned. No other treatment. Simply ignore it. Or if I say very simply, permanent difference, ignore it when you want to calculate your deferred tax asset or liability. How can you ignore it? simply put its tax base equal, keep its tax base equal to its carrying value, so automatically no difference will arise, because this permanent difference will have no effect on deferred tax.
What about provision for doubtful debt expenses? Is it a deferred tax asset for Hamza?
Farhan, see, provision for doubtful debt, what does it mean? In fact, you reduce your receivable by this amount. Whereas in some country, tax people does not allow this. Like if your receivable is 100,000 zakah and your allowance for doubtful debt is like 10,000. So in your carrying, in your books, the receivable will be 90,000. Whereas from a tax people point of view, the tax base will be 100,000. They do not like allow in some countries this 10,000 unless it is incurred.
Okay, when these handouts will be available to us?
Right after this session, inshallah.
Okay,
Am I correct?
Yes.
Okay.
Yes. When will the respected trainer commence series of webinar on international standards on auditing?
So that will be Burhanuddin. That will be announced soon, inshallah. But I just want to share one thing with you people. Like I have an idea. So if you people feel that that idea is beneficial for our respected members, so then I need you people's support in the implementation of that idea. I want to establish a responsive and vibrant technical committee here in Pakistan. Though Mensa members are also listening to me, I mean, I have no problem if we can uplift this like committee to Mensa region. What is the objective? The objective is all members from this region should forward their technical issues, real practical technical issues to this committee. This committee will consider those issues, find out the solutions, and send the solution back to that respective members, but also place that solution and the problem on the ACCA website as well, so that in future, if someone has the same problem or if someone has any technical problem, he can go to the website of that technical committee given on like ACCA website. He can see his if his problem is already discussed in those technical issues. If not, he can write his problem to the technical committee. Then another idea is that this technical committee should make sure that all members should have free access to the original IFRS and ISS. And likewise, these are some of the suggestions which I have in my mind, so that we could equip our respected members with all these technical abilities, technical tools. And another is like if there is any development so far as the implementation of the standards or like adoption of the standard is concerned by like SACP Pakistan, State Bank of Pakistan, or Institute of Chartered Accountant of Pakistan, we must have a say. This technical committee must contribute towards that activity. So if you feel that like this technical committee can will be beneficial for you people, then I need from you people those who are interested to become the part of that technical committee. So that because it is not only me, I want to make a group of talented ACCAs who can contribute towards the community by helping them in resolving their technical issues related to IFRS and ISS. Now there is a pop-up for feedback. So Khayam, please. Please.
Before popping up the feedback, I must request all members to see the link that I am sharing on the presentation screen with them. This is the Google Doc link for all the handouts. All the webinars handouts are available there, so you can download those handouts. And this is for information to those attendees who are requesting time and again. So I'm going to pop up the feedback question just in a bit. So it's on your screen now.
Can you mute it? Mute it.
Okay, so I'm going to close this poll now. We have the statistics with us. Around 38% people saying excellent, 49% people saying very good, 11% people saying informative, 2% people saying average, while 0% saying unacceptable. And we have another question, pop-up question in respect of.
Meanwhile, thank you very much from my side, and I'm really thankful for your participation in all these sessions, and this gives us motivation to do more such sessions and to engage more constructively with the members. Thank you very much.
For people who are saying other, they must write to us in question box. And in the meantime, I am going to announce that ACCA Pakistan soon will be having MNP election. So far, we have received requests of nominees. Their documents have submitted with us, and in the meantime, ACCA Pakistan will announce a date, so all the attendees are alerted to cast their vote. All you guys have been requested to participate in the election, so that right individual will be representing you in the member network panel, and they can raise their voices. And I hope I must announce on behalf of Mr. Abu Bakr that he is also participating in the election. So good luck to everyone, and I hope you guys will make the right choice. So I am going to close this poll now. So we have around 55% people saying Pakistan, while 5% people saying Bangladesh, 33% people saying UAE, including Qatar and Oman, 7% people saying others. So I am going to pop up the question box. Okay, so question box is here. no one have mentioned here. Anyhow, we have received some compliments for our trainer. Lots of people saying thank you, great session today. And in the meantime, the trainer have conveyed his thanks and best wishes to every participant and to every listener who will be attending or listening to the recorded version of this webinar. Thank you everyone and good luck. Have very best of luck from ACCA team to all the attendees and to all the participants. Thank you, and I'm going to quit now. Good luck, goodbye, Allah Hafiz.